Hello, Matthew Bell here, and today I'm going to continue a series that I've been doing on tax-qualified employer-sponsored retirement plans, and in particular plans that are defined contribution plans. So in a previous video I did the 401k. We talked about the 401k, and I encourage you to take a look at that video. Today we're going to be talking about the 403b, and in a future installment we'll talk about the 457b. Just in general, the differences between them, the 401ks are going to have mostly to do with for-profit companies. The 403b is often tax-exempt or 501c3 type organizations, and the 457 is often government. There are a few other differences, and we'll kind of go into some of those. But because the 403b and the 457b both share a lot in common with the 401k, I would encourage you, if you have either of those other two, 403b or 457, to still watch the video on the 401k because you will gain, I think, an understanding of a number of things that are going to be relevant to your own plan. A couple of things to start off with. First of all, where do the names of these things come from? And the answer is they come from the Internal Revenue Code. So 401k, 403b, these are sections of the IRC, the Internal Revenue Code. So if you go to section 403, subsection B, you'll read about the relevant paragraphs that are going to have to do with the 403b plan. Now there's at least two types of 403b. One is a non-matching or voluntary only type plan, and the other is a matching plan. So there are a couple of definitions actually for employer-sponsored, and one of them would require basically that an employer-sponsored program offer some sort of a match. So if the 403b doesn't have a match, if it's that kind of 403b, then in one sense of what it means to be employer-sponsored, certain 403bs are not technically employer-sponsored. But this is a kind of a detail. I'm choosing to include the 403b in my discussion of employer-sponsored plans because if you're going to have access to one, you're going to have access to one through your employer for the most part. So I'm not thinking of employer-sponsored in the first place as the match, but as just you have access to the vehicle through your particular employer. Now, 403bs were put in place in the 1950s, I think 1958, and at that time the only investment option for this type of plan was an annuity. And so this particular vehicle had the name of tax-sheltered annuity. And even to this day, you'll hear some people refer to a 403b as a TSA, or a tax-sheltered annuity. Now, since 1974, there have been other investment options offered besides annuities. So for 403bs that are enforced today, a lot of people are going to have the option of investing in mutual funds within the 403b. But because they also have annuities, or you can also put money into an annuity, you might want to also look at the other video that I have on kind of sketching annuities. Just in basic terms, an annuity is a vehicle that guards against you living too long. Kind of sounds odd to say it that way, but the idea here is longevity risk, that at some point you are going to outlive your money. So an annuity is a means basically of purchasing for yourself an income stream in order to try to guarantee that you don't run out of money at a future point in time. So 403bs are mostly going to be available through public schools, other kinds of charitable organizations and the like of this, churches. Sometimes self-employed people can also have access to a 403b. Unlike a 401k, the 403b generally doesn't have any kind of profit-sharing component, and this kind of makes sense because when you think most of the organizations, or many of them that are going to have the 403b available, they're non-profit organizations, so they're, technically speaking, isn't profit in the same way to share. There are a couple other differences. One is that we talk in the 401k video about how the contribution level, 19,000, there's a catch-up provision for 401ks, so that if you're over the age of 50 and your plan allows for it, you may kick in an additional $6,000 a year, bringing you in 2019 anyway to 25,000. The 403b often has an additional catch-up provision, and that basically states something like this: that if you have been with that company for 15 years or contributing to your 403b for 15 years, then as you approach retirement, you can kick in an additional $3,000 a year on top of whatever other contributions you might qualify for, and that's up to a limit of about $15,000. So you figure as you near retirement, you may be able to kick in an additional $15,000 over the course of 5 years at $3,000 a year with a 403b. As always, if you have any questions about the particulars of your 403b, contact your plan administrator, your human resource department, and actually look at the benefit package that you have associated with your 403b. Now, as I started by saying, there's two different kinds of 403b. Some are matching, some are non-matching, and it basically has, in the reading that I did for preparation, it basically looks like when there's employer matching, then the 403b is subject to the Employee Retirement Income Security Act, or ERISA. And when that happens, there's additional oversight and scrutiny on the 403b. So some employers who offer a 403b don't match for the reason that they don't want to invite that additional scrutiny. Others, it is possible to match in a 403b, but then it changes its status under law. So essentially, it would not be governed by ERISA if there's no match, and if there is a match, it would be governed by ERISA. That's the understanding I have. Now, as I said sort of in the introduction, one of the main differences right off the bat between a 403b and a 401k is going to be who actually sponsors the plan. So in the case of a 401k, the plan is essentially going to be sponsored by a for-profit company, a publicly traded company, something like this, and that is primarily what the 401k is available for. Now, having said that, since 1996, according to some of the sources that I consulted for this video, in 1996 that kind of started to open up a little bit, and so some tax-exempt organizations are offering now the ability to start a 401k. So the point is the differences are kind of getting less and less as the years advance. The differences between a 401k and a 403b are decreasing, but there are still some. Now, the 403b has a lot in common with its cousin, if you want to say it, the 401k. A lot in common. So the first and most obvious thing is that the main benefit of the 401k is from a tax standpoint, and that is that the 401k contributions are going to be deductible in the year you make them, and the same goes for the 403b. The contributions you make to a 403b are tax deductible, and that means that that money is not counted as part of your gross income when you file a tax return. So the example I typically give is, let's say, abstracting away from any other consideration of tax or income. Let's say you have a gross income of $100,000 and you contribute $6,000 into your retirement account, 403b, you'll have a $6,000 tax deduction, and depending on what tax bracket you're in, again, I'm just going to use 10% to make the numbers up. It's unlikely at that income level you would be in a 10% bracket, but nevertheless, I'm using it just for the sake of easy math. At 10% income, $6,000 deduction would be worth a $600 tax savings for you. Also, similarly to the 401k, once funds are inside of the 403b, they're going to grow on a tax-deferred basis. So you're not going to get a 1099 for your earnings in a given year. The money, when you put it in, you get a tax deduction, it grows tax deferred, and then you're going to pay tax on it when you go to take money out. So when you take distributions from the 403b, you're going to pay tax on everything, your contribution and whatever earnings have accrued. Now, just a word on that, of course, a 403b, if it's invested, let's say, in mutual funds, there's no guarantee on the market returns. So there's no guarantee on the amount of money you're going to be able to take out. This is why it is referred to as a defined contribution plan, because the parameters of putting money in are well defined, but what comes out of it is going to be a function of how well the investments have performed and a number of other factors. So the guarantee, if you want to call it that, is not on what you're going to get out of it. It's on what you or your employer are going to put into it. There can be vesting. Vesting would be the time period during which you will have to serve your employment dues, so to speak, with your employer before you'll have full access to any money that is put in by your employer. In employer-sponsored plans of this kind, you're typically vested in your own contribution from day one, meaning that any money you put in, you have ownership rights over. There may be restrictions on accessing the money, and there are restrictions on how much you can put into the account, but you're vested in your contribution. However, the money that your employer puts in, you may or may not be vested in. There's typically some sort of a vesting schedule, and that would mean that you'd have to work for your employer for a period of time, 2 years, 3 years, 5 years, 6 years, in order to have full ownership or full claim to the money that your employer puts in. And that would be for plans that have matching. Now, fewer 403B plan administrators are going to match than 401ks. According to some of the information that I read, I don't have worked out on full statistics on this, but the idea is intuitive, and that is that a 401k is typically offered by a for-profit company, so the idea is you may have more profits and more ability to provide a match. The 403b might be a tax-exempt organization, and they might be a little bit short on extra cash, so they do provide that their employees can start to save for retirement, but they may not provide a match, or at least they may not provide it to the same extent you might get with a 401k company. 403b also differs in some respects in terms of who can have access to that retirement vehicle. 401ks are usually available only for full-time employees. 403bs are sometimes available for people who work part-time, and there's often what's called the 1,000-hour rule, or you figure if you work 20 hours a week and 50 hours or 50 weeks a year, if you can hit 1,000 hours, then you have the ability to contribute to a 403b. But again, consult with the administrator of your plan for actual details on how and what applies to you in your situation. Now, my understanding of the 401k and the 403b is that, let's say you have access to both, and a few people do. My understanding is that the contribution limits apply to both jointly. So you can contribute up to $19,000, but you can only do so in total of the two accounts. So if you did 9 to 1, you could only do 10,000 to the other, because your contribution limit applies to both together. But again, like the 401k, and in 2019, there are limits on the amount of money you can put in, as we just said. So you have a limit of $19,000 that you can put in if you are under the age of 50. If you're over the age of 50, then there is a catch-up provision that is allowed for. That would be an additional $6,000 to bring your contribution up to $25,000 if your plan allows for it. Now, penalties on early withdrawals are generally applicable only if the plan is governed by ERISA. So there is a 10% early withdrawal penalty if you withdraw your money before the age of 59 and a half. So generally, from the reading that I've done, it looks like any plan that is governed by ERISA, you have you are susceptible to a 10% penalty on top of whatever tax you owe if you make a withdrawal before the age of 59 and a half. Withdrawals before the age of 59 and a half are termed premature. Now, you have to realize that there's a difference between tax and a penalty. Since the money in the 403b has never been taxed, your contribution hasn't been taxed, the earnings are tax deferred, you are going to pay tax no matter what, and tax is not the same thing as a penalty. It might feel that way, but a penalty is a 10% tax or charge on top of whatever normal earned income tax you would have to pay on your withdrawal. Now, there are certain exceptions for deductible medical expenses. If the plan participant dies or is permanently disabled, then there are exceptions. A person can access funds typically without a penalty prior to that. But if the 403b is not governed by ERISA, then apparently the 10% penalty doesn't apply. But you still have to realize that typically the plan, even if it is not governed by ERISA and not subject to a 10% penalty, there may still be a prohibition on withdrawing money before the age of 59 and a half, and that's just typical for retirement vehicles. Now, there may be a little bit of a looser definition in terms of what can qualify as a hardship. So in a 401k plan, besides death, disability, and medical expenses and the like of this, there are sometimes provisions for a person to access funds before 59 and a half for hardships. And in a 403b situation, I think it's termed unforeseen emergency. So if you can demonstrate that you have an unforeseen emergency, you may be able to take money prior to 59 and a half. The main thing about these vehicles is they are retirement vehicles, so they are designed to have you access the money in your retirement and not before. So just in summation, some of the similarities between the 401k, the 403b are going to be the fact that they're retirement vehicles, so they're designed to be accessed after 59 and a half. They are funded with pre-tax dollars, meaning you get a deduction for your contribution, and then the money grows tax deferred while it's in there, the earnings, if any there are, and then you pay tax when you take your distribution. An additional consideration is that even though you may start taking money at 59 and a half, the IRS provides that you must start taking it by 70 and a half, and that's called a required minimum distribution. At the age of 70 and a half, the April the 1st, and the year following the year you turn 70 and a half, the IRS is going to require that you start taking money out of the account, and they have a table for this. I'll get into more detail in another video, but they have a table to determine based on your age how much you have to take out. It's not the whole thing, but it is a withdrawal that you are required to take, and if you don't take it, there's a hefty 50% penalty on the amount you should have taken. Loans may or may not be permitted in these kinds of plans. Again, contact your plan administrator. Loans are typically not subject to tax, and if there is a penalty applicable to your plan for early withdrawal, loans are typically immune from that. Doesn't mean taking a loan is a good idea. You probably want to have a discussion with your plan administrator, with a financial advisor, somebody who can actually help walk you through the potential costs to you, including something basically called an opportunity cost, meaning that if you take money out of a vehicle where your money could earn something, then you don't miss just out on the money you took out, but you miss out on the money you could have earned with that money, if that makes sense. Rollovers and direct transfers are permitted, which means that if you have an employer that offers a 403b and you leave, you can roll over the amount in that 403b into, let's say, a new 401k plan with your new employer, or into an IRA. Consult with a competent professional for details on that kind of thing. And finally, these vehicles are used to build up a nest egg, and in the past this was thought of as basically the third plank of a threefold strategy for retirement. So it's called, basically, sometimes you'll see it referred to as the three-legged stool, and in that idea you would have basically Social Security, an employer's pension, and then your personal savings, whether it's in 401k, IRA, 403b, whatever. Well, because employers are fewer and fewer that are offering a pension, that has really become a two-legged stool. And if you look at Social Security projections, they're not exactly rosy, and some people believe, without getting into the politics of it, some people believe that Social Security may not be around, or that it may not be able to provide the benefits that some people think it will, which means that we might be down basically to one leg. Well, the stool is not going to stand up very long with that, but the idea is you have to realize that a lot of the focus of your retirement plan is going to have to be on you and your own plan. You are going to have to take ownership, in other words, and try to understand these as much as possible. My motivation for doing this, as I've said in other places, is the situation that my mom is in, that I'm in. My dad had to go through a Medicaid spend down, and I'm trying to help her to piece together a retirement from some real problems that she encountered because of my dad's health situation. So this is something that benefits me, my family. Have this information. I hope that if something I said was of use to you, that you would please like the video, subscribe to the channel. I'm going to talk about 457s in another video. I'll talk about IRAs, I'll talk about Roths, talk about annuities in general. I got a number of topics lined up. So if you found something of use, again, I appreciate you liking the video, and thank you so much for your time today.